Professor Douglas Arner specializes in economic and financial law, regulation, and development. His research focuses on the intersection of finance, technology, and regulation, particularly in the context of digital currencies and emerging markets. Professor Marko Dimitrijević is a monetary law and policy expert at the University of Niš. His research examines the legal foundations of monetary systems and their adaptation to digital currencies. Professor Christos Gortsos is a distinguished financial, banking, and capital markets law scholar at the National and Kapodistrian University of Athens. He serves as chair of the EBI Academic Board and focuses on the legal framework for banking supervision and monetary policy about digital currencies. Professor Seraina Grünewald specializes in financial market law and regulation at the University of St. Gallen. Her research focuses on the regulatory challenges of digital currencies and their integration into existing legal frameworks. Dr. Christian Pfister is an expert in monetary economics and central banking at the Université d'Orléans. Having worked previously at the Banque de France, his research focuses on the implications of central bank digital currencies for monetary policy transmission and financial intermediation. Professor Heng Wang is a specialist in the governance of digitalization at Singapore Management University. His research examines the governance and regulation of digital transformation and their implications for the public and private sectors. Filippo Zatti is an economic law professor at the University of Florence and a fellow of the European Banking Institute. He co-founded BABEL, a blockchain and AI research unit at the Department of Economics and Management, in March 2019, and has served as its scientific coordinator since. Professor Zatti's research examines legal challenges in blockchain technology adoption within the financial sector, digital asset regulation, and central bank digital currencies, with particular focus on their implications for legal tender, monetary policy, and financial stability. He recently co-edited Digital Assets and the Law, Fiat Money, in the Era of Digital Currency for Routledge Giappicelli Studies in Law series.
Welcome back. Good morning. Now you know why we decided to use the video presentation, because we are always late and we have to stay on time. So I have the honor, please. Oh, thank you. Yes, as Christos told yesterday, it's a pleasure to present our colleagues, but it's also a pleasure, a great pleasure to have the time to hear properly. So this is the reason why we thought to a video presentation. I limit my introduction to two things to remind, if I'm correct, please correct me in case I'm wrong. I will give the floor to Christian Pfister, then Christos, then Seraina, Marko Dimitrijević, Douglas Arner, and Heng Wang. The three last speakers are online, so you can see them remotely. And my introduction is just this image, the portrait of card sharps of Caravaggio. I never say more than this about financial stability, the risk induced by the proliferation of payment system confounded with money, and I leave the floor immediately to Christos.
Thank you, Filippo. Thank you to BABEL and to the EBI for giving me the opportunity to present my views on...
Perhaps.
Sorry,
Christian, if
can you hear me?
Use this mic.
Sorry.
Perhaps
Okay.
it's better. No. Yes,
it was on. It was already on.
Yeah.
Okay. Thank you, Filippo, and thank you to BABEL and to the EBI for giving me the opportunity to present my views on legal tender. I'll talk also about possible consequences for monetary policy and financial stability, of course. Caveat to start with. I know this is...
Yeah, is it possible to...
Okay, to
speak
tune up.
louder? Yeah.
I know this
We want to hear your voice.
Okay.
Your important voice here.
Thank you.
Thank you.
My presentation will be an economic one. I know this is primarily a conference of legal experts, but myself, I'm an economist, so I cannot pretend to have competences on legal issues, just general information, I would say. My focus would be on CBDC, especially the retail form, and my focus would be also more specifically on the euro area. Each time I have to make a presentation in conference, I prepare a paper. There are two parts in the paper I prepared. First part discusses considerations on CBDC legal tender in an IMF working paper by Bossu, Rossi, with us today, and co-authors. I will skip that part. I'm sorry, Arthur, but you're much better placed than me to talk about it, about this paper. But I will build on one conclusion of this paper about account-based CBDC. The authors note that central bank book money, what we usually call deposits in common language, does not usually have legal tender status. And they mention that this is not a problem because in most countries, central bank book money plays today a central role in the monetary system without having such status. So in second part, which I'm going to present now in more depth, I generalize this conclusion. I start with an observation, which is that legal tender is for CBDC is usually taken for granted, but this is predicated on a bold assumption. I will be more specific in a moment. Legal tender is very often predicated on the assimilation of CBDC, or at least a retail form of CBDC, to a digital form of cash. You find this phrase both in the IMFW paper, working paper, but also in the draft EU regulation on the digital euro and in numerous statements by central bankers. This is what I would call a Darwinian approach to cash. Up and low. Okay, so okay. Sorry. For changing the slide. So, sorry, so what's speaking? Okay, okay. So I do that myself. Thank you. In which direction?
So you play me. This one.
Yes, the direction from the machine. Which? Oh, thank you. It's very complicated. I'm sorry, too complicated for me. Yes, legal tender is predicated on the assimilation of retail CBDC to a digital form of cash. This is what I call the Darwinian approach. Legal cash would have to adapt to the digital era, so move from a physical form to a digital form. However, in my view, the phrase digital form of cash is an oxymoron. Why? Because the features of cash differ widely from those of digital means of payment. You can see that in remote transactions, very difficult to use cash in remote transaction, a very risky tool. Offline transactions, impossible to use cash. Online transactions, impossible also. There are costs which are different. The cost of using cash accrue mostly to merchants. In the case of CBDC, the cost would accrue mostly to banks and to central banks. The risk of loss or robbery are widely different, and as regards privacy also, only cash fully preserves privacy. I know that central banks have committed not to use personal data on personal transactions, at least in democratic countries. But I don't think that's what the users care for. When they asked about their concerns about privacy, what they cite first, as a concern, is big techs, then government, and then banks. Banks are the institutions that people, to my knowledge, in all countries where polls have been conducted, trust more. They trust banks more than government and more than big techs. Big techs are hated as far as privacy is concerned. Furthermore, legally, cash is currently the only form of money which is also a payment instrument. So the question arises, how make CBDC legal tender? There are two solutions to that problem. First one would be to make the legal unit of account legal tender. This is a process suggested by Filippo in his contribution to the book he co-edited with Rosa Giovanna. But in that case, the government would lose one privilege, the privilege of using the legal tender. The other possibility would be to detach the notion of legal tender from that of payment instrument and attach it instead to the public nature of the money issuer. This would be a total fait du prince, but incidentally also it would extend the privilege of government also to the WCBDC and to reserves. So in my view, it's much more likely. And as I said, it's a fait du prince, and the prince usually serves his own interest. Which is very logical. I have no problem with that, but we have to admit that. So, say, okay. No, conclusion. So, here. I go on noting that the cost for society of legal tender could outweigh the potential benefits. I first note that people do not know what legal tender is and do not mind. When asked about their preferences, what they quote first in all countries in the world is convenience. They want convenience. Most people young people I know, never use cash. When I ask them, what's your preferred means of payment, they say cards. They want to use cards. If they'll never ask if the one payment instrument has legal tender, they don't know what legal tender is, as I said, which one would you say first? And in the case of these people, they would say cards. They would never think of cash. So convenience matters first. Noting that making CBDC legal tender could, in fact, reduce the choice of the payment instrument because it would be CBDC are likely to be launched in combination with other non-market features. And I refer you to the case of the draft EU regulation. The digital euro would be free for users with a wide range of basic services which would be provided. There would be very low transaction fees, with transaction fees limited to the first quartile of the distribution of fees that would be observed by the ECB. And this would have two consequences. First, because of very low fees, merchants could refuse other payment instruments. Second, entry into the sector would become extremely difficult because network effects play in favor of insiders. Visa and MasterCard, to give names, can live with very slim margins. They don't care. They benefit from huge network effects. They can earn a terrible amount of money with very slim fees. But if you're an insider and want to enter the market, you need to have high fees. This is how, for instance, cards were created. Cards were created by Diners Club, and they were very exclusive. Fees were very high. They were an element of distinction, let's say. It was chic to have a card. And then, as network effects came into play, fees could be reduced. The same scenario was not adopted for CBDC. the scenario is rather a wide adoption, and from the start, so fees can be very slim for CBDC, without triggering too much of a problem. But for private competitors, this is impossible to enter the market unless you are a big tech. If you're a big tech, you can afford losing billions during 5 years. You don't care. You know that in the end, network effects will play in your favor. So this would stem innovation, having only a few players in the market. Finally, payment of taxes in CBDC could be mandated because there would be no limit to payments in CBDC, in the case of the digital euro, for instance. And if it is not foreseen initially, holding of CBDC could be extended to public institutions and possibly also firms, which would allow to pay social benefits and salaries in CBDC. The risk is then that so-called walled gardens that have been denounced by Christos, for instance, from the BIS, could play not in favor of big techs, well, not only to some extent in favor of big techs, but above all in favor of the issuer, that is central banks, more widely the government. Just think of the creation of a new tax. Usually in seniorage is a tax. When a new tax is created, it's transitory. It's for a very small amount. It's how the income tax was created, for instance, in my country, just before World War I. And then it was extended, and it became a major source of taxation. Impact on monetary policy and financial stability would likely be limited. As seen above, it's not so much legal tender, but rather its combination with other non-market factors which could amplify the consequences of launching a CBDC. I focus on monetary policy for sake of saving time. Regarding the transmission mechanism, the interest rate channel would not be exploited by central banks because in most cases, and it's the case for the digital euro, zero. Not no interest, but zero interest rate would be paid on the digital euro, with the consequence that, of course, individual holdings would have to be limited. If you do not limit individual holdings, then if you adopt a negative interest rate policy, banks store retail CBDC instead of paying interest on the deposits, on the reserves they hold. Regarding the credit channel, so interest rate channel wouldn't be impacted. Or rather, the opportunity to make it more efficient would be missed. Credit channel, there would be a risk of disintermediation and fall in banks' profits, especially the fees perceived on transactions. But on the other hand, the move towards 100 reserve, launching a retail CBDC would be a move towards a 100 reserve system, which is usually considered as safer than the current system we have. And furthermore, initial conditions would come into play. By initial conditions, I refer especially to the fact that there is a wide liquidity surplus. In the case of the euro area, the liquidity surplus represents around 40% of the holdings of current account deposit by individuals in the euro area. So you can disintermediate up to 40% of those deposits without causing any liquidity problem to banks. The most serious risk, in my view, would not arise in developed economy, but rather in developing economies, which is a risk of dollarization, but it would be caused in the case of the US dollar by stablecoins, not by CBDC, since this is a decision not to issue CBDC, a decision, of course, which could be reversed in the future. Regarding the implementation of monetary policy, Retail CBDC would act as a liquidity absorber, as I said. The more you issue retail CBDCs, the less bank hold reserves, the substitute for reserves in the central bank balance sheet, and it would act as an autonomous, so-called autonomous factor. An autonomous factor is a factor which is beyond the control of the central bank. Typically, banknotes. Banknotes, the demand for banknotes drives the issuance of banknotes. A central bank cannot say, no, you want banknotes? No, I'm not going to give them to you. If a bank has appropriate collateral, it gets refinancing, and with the reserves, it buys banknotes. But as I said, there would likely be excess liquidity at the inception. Note that the ECB has not committed to suppress the excess liquidity, which is currently at the in its books. Overall, in my view, there would be no big deal regarding monetary policy and financial stability. I've briefly touched upon financial stability about the risk of disintermediation, since arguments point in opposite directions. To conclude, I hope I've not been too long, Filippo, and not exceeded too much. I've been too long. So no, I'm fine. Thank you very much. So there. Oh, sorry. Conclusion. What are, in my view, the most important issues, or issues that matter, that were very much debated, but in my view, that are not major issues. Such issues is how make CBDC legal tender, or is a retail CBDC likely to make monetary policy more or less efficient, or could a retail CBDC harness, or
Christian, yes,
or endanger, thank you, financial stability, or how limit such risks. But as I said, in my view, such issues are rather overplayed. But more major, more substantial issues are most of the time overlooked. Such issues are who would benefit, who would lose from legal tender of CBDC, or is there a market failure in the payment industry which would justify launching a retail CBDC, or even more substantially, is it the role of the central bank instead of the private sector to provide payment instruments or money to the public? Retail CBDC would be both a payment instrument and money beyond the historical accident that a public banknote represents. Well, from the second perspective, which you have understood is mine, legal tender should not be extended. It has now turned into a barbarous relic. Thank you very much for your attention.
Thank you, Filippo. Thank you, Christian. Mike. Thank you so much. So I leave the floor, hoping that the mic's problems is solved, to Professor Christos Gortsos.
Thank you very much again for the invitation and the great hospitality. Good morning, ladies and gentlemen. This is a PowerPoint presentation on which I will show only 2 slides, as usual, by the way. Because I would like to concentrate first in my brief introduction. Let me check that I will be on time. Yeah, I have a very heavy history from yesterday, yeah, interrupted everybody, so I need to stick. But I learned from you that this works better, yeah? I will use it in the future. You will allow me first to make some comments on a topic that was discussed yesterday and you yourselves, Christian, developed today, on the notion of the legal tender. Because I think there is a lot of misunderstanding with regard to this. And it may be of interest to put some thoughts, and then you can attack me that I'm wrong. Not yourself, everybody here. Okay, everybody. Yeah. Okay. I see Christos Hadji Emmanuel here. Good morning, Christos. I'm sure that he will agree with me 50% and then fully disagree another 50%.
The other side of Christos.
No, we have this discussion for the last 30 years, so there is no problem on that. Now, let me go back to the theory. What is, where does the legal tender status come from, yeah? It's very much based on the so-called, you may like it or not, the legal theory of money, yeah? And this goes back, traces back to works of Nussbaum and then mainly of F.A. Mann. And there you will find the definition of what is a legal tender. And the legal tender status is what, by the way, the state, not necessarily the government, the parliament, yeah, the legislator would consider to have the legal tender status. In that respect, it is a privilege of the state to dictate which means of payment, which money in the economic term of, in the economic meaning of the term, would have this status. Legal tender means inter alia, but mainly it implies the principle of mandatory acceptance, correct? And this, we go back from public law to private law. It means that in terms of monetary obligations, yeah, if I have to pay with means of payment, yeah, which is, has a legal tender status, I need to do that unless my counterparty agrees to the opposite, correct? The fact that, or the legislation provides that you need to make a payment in a certain way, because you may have that as well. Let's put that in our current context without legal tender status. I owe to Seraina 100 Swiss francs or 100 euros. According to the legal theory of money and according to the fact that the Swiss franc in banknotes and coins and the euro in banknotes and coins have legal tender status, yeah, I need to pay you in this unless we agree that the payment can be made through a bank transfer, correct? The bank transfer does not have a legal tender status, yeah? But the payment with banknotes, unless the banknotes, yeah? The banknotes and coins do have this feature. Today, in the European Union context, according to the treaty for the banknotes, Article 128, paragraph 1, the coins, according to secondary legislation, it is the digital euro regulation from 1998, correct? Now, it may be the case that if the payment is over 1,000 euro, I would be required for different reasons, yeah, according to my national law, according to Greek law, or according to Italian law, that the payment should be made through a bank transfer, yeah? And this is in order to protect specific policy objectives, like, for example, avoiding tax evasion or countering money laundering, correct? This, in my view, leads to the conclusion that the fact that specific means of payment have been given the attribute of a legal status does not prevent the making of payments with other means, correct? Yes. And we know that the card payments, for example, do not have, not linked to any legal tender status, yeah? And we know that most of the transactions are being made by means of payments, yeah, which do not have the legal tender status. That's correct, yeah? The majority, I would say. So now the question arises, why should we give also the digital euro the legal tender status? That's the question that I think we all are considering, yeah? In our days, all this discussion, I think, was more or less settled before the recent developments in financial technology. And currently we're asking, why is the Commission proposing in its regulation, in the regulation of the co-legislators, that the digital euro should also have a legal tender status? I think this is the key issue that we need to address. Yeah, is it appropriate to do that? And I keep one phrase that you mentioned before, and which is very interesting. People do not know what legal tender is. If I read this, yeah, it means that if you give the legal tender status to the digital euro, it means that there will be the mandatory acceptance rules. So people may not know that if they were be paid by a legal tender, yeah, by a digital euro, they would have to accept. This is the logical implication of what you asked before. And this is what is linking the ignorance, the financial literacy issue of the digital euro, yeah, which is one key element of our discussion on the digital euro, how people be aware, to the fact that if the digital euro were to retain, which I think will be the case, the legal tender status, yeah, and unless you have the exceptions to this rule, because it is quite balanced, yeah, for small and medium enterprises, it might not be, and correctly in my view, not be mandatory to accept the digital euro. So in this case, some people will be in a limbo. So for those of you who are dealing with financial literacy or digital literacy aspects of the digital euro, please keep that remark very much into consideration. Yeah, I think it was a very valuable input from the previous presentation. In that respect, legal tender status is attributed by law. And if you allow me that, the question is why doesn't the legislator assign this status also to eggs or to stones or to chicken? Yeah, apparently because it cannot control the provision of this, and this goes to a kind of a monopoly of the state through the legislator on attributing to specific means of payment this attribute. In my view, it's a minor issue, yeah, except for the point I mentioned before, the fact that it may be the case that people who are not accustomed with digital transactions, yeah, might be required to accept a means of payment that they would not understand how it works. But again, this should be discussed within the context of the provisions of the proposed regulation as it's going to be adopted. A second final point on this, and then I will turn into a second aspect that I would like to discuss with you, is that it is the first time that the European legislators have decided to clarify the meaning of the legal tender status in a second proposed regulation, which is included in the trilogy of the Digital Euro package. Yeah, the Digital Euro package contains 3 proposed legislative acts, one on the introduction of the digital euro, one on the distribution of the digital euro in the member states who have not yet adopted the digital euro. So Croatia is not anymore affected by this, yeah, but Bulgaria and Romania will be, correct, and Hungary and Denmark and Sweden. And the third is on the legal tender status of banknotes and coins, yeah. Because we don't have legislation on that. It is provided in the treaty. It is provided in the Regulation 974 of 98 on the introduction of the euro. We do have case law, but very limited one. I think it was only in the Rundfunk case some years ago. En passant, they have discussed that. And we have a commission communication on this. So we don't have a solid legal basis, yeah, apart from the treaty, of course, which is in order to interpret what this means. But from what I have seen, the bottom line, again, is that it is about the mandatory acceptance of the means of payment. This is the key concern in this discussion about the legal tender. So from an economic point of view, the legal tender, I would say, would be a kind of restraint in the use of a means of payment as the economists understand it, yeah? It is a constraint that this specific means of payment must be accepted. The second part of my presentation, very briefly, how does this work? Let me. Okay. We simply go to the tables at the very end. Let me. Is that here? No. No. This one. Okay, fine. According to the proposed regulation for the digital euro, there will be some limitations on the use of the digital euro as a store of value and as a means of payments, yeah? These limitations have been set as analyzed in the article and very analytically in the considerations in order to preserve financial stability, my last 5-6 minutes, not to intervene with monetary policy, yeah, what Seraina will develop later on, and is also related to the fees of the digital euro payment services. I think that this is a point that may. I can. Yeah. I'm too old to combine two things together. But yeah. No. Okay, fine. So I have tried to stylize a little bit the considerations concerning the fears relating to financial stability. And in order to do so, I have set up two tables, one with a basic scenario in which the demand for the digital euro would be mild, yeah? And I'm trying to check what will be the impact on credit institutions' balance sheet and on the euro system balance sheet, and then to take the adverse scenario, which in my view would pose the real threat, correct? Because in this case, you would have a higher substitution of deposits. This will be the problem with digital euro. First of all, let's clarify. I think many people mix that. The balance sheet of the banks will not contain any digital euro, yeah? This will be a liability of the central banks. Being a liability of the central banks, meaning the ECB and the national central banks, it will only be on the balance sheet of the central banks, correct? So it cannot be on two balance sheets. So in this respect, if you have a mild demand for digital euro, you may have a substitution. The demands for digital euro will be reflected on the liability side of the central bank. You may have a reduction in banknotes in circulation, and eventually the liabilities held by the banks to the central bank, not in terms of the reserve requirement, because this is dictated by the central bank, but in terms of using the deposit facility, may also be reduced. So at the end of the day, the balance sheet of the euro system would not be affected. According to a mild scenario, don't ask me what a mild scenario means. We need to have that in figures, but we'll come back to this. And again, on the balance sheet of the credit institutions, you would have an outflow of deposit, yeah? Because people, instead of going to the ATM to withdraw banknotes, they would transfer funds through their digital wallet from a deposit account into the wallet. They would eventually reduce their reserves at the euro system, again, the part of the reserves that they control. And this is the deposit facility. The situation becomes apparently more complicated and dangerous, if you wish, if the outflow would be more significant. Because in this case, as I show, the deposit outflow will be higher. And in this respect, it may be that by reducing their reserves at the euro system, even if you wish, if they put to zero their deposit facility, this may not be sufficient. In that respect, they may need to borrow, yeah, in order to substitute the deposits that have outflown in order not to deleverage. Correct? This is the key concern. To what extent the withdrawal of deposits in order to meet the demand for the digital euro would not lead to deleveraging. And here, theoretically, you have some options, yeah. You can sell your securities, but let's hope that you are not in a situation like Silicon Valley, yeah. But okay, we have learned from that. You may wish to issue securities, but it depends on the market conditions, correct? And it may be dangerous, yeah, in that respect. And you may need to have more resort to central bank funds. So in this respect, yeah, it may be the case, and this is my preview, that the balance sheet of the euro system on a consolidated basis might be affected. I mean here, it would have to be increased. And this would have an impact on monetary policy. I can stop it here, and I hope that we can further discuss it during the following session. Thank you very much.
So, great. Gortsos, Professor Christos Gortsos. Just in time. And I'll leave the floor immediately to Seraina.
Okay, let me try what to add
Professor Seraina Grünewald.
Thank you very much. It seems to work now, which is excellent. I'm just waiting for my slides to appear. Good morning, everybody, and a very heartfelt thank you to the organizers of the conference. You really did a fantastic job. Thank you for your hospitality and for having me here today. I very much regret that I couldn't be here yesterday, and I'll try to make up today and sort of understand and absorb all the inputs that come together here. Now, I'm not going to speak about legal tender. I'm going to speak about retail CBDC and its potential use as a monetary policy instrument. What I will be presenting today is very much work in progress. It's based on a paper that I'm co-authoring with my PhD student, Filippo, who's also here today, an expert in retail CBDC, and he deserves at least as much credit for that paper as I do. We are obviously very much interested in your feedback. Now, what was our motivation to look at retail CBDC as a potential monetary policy instrument? Christos already elaborated on the risks, potential risks that retail CBDC could cause for monetary policy transmission, in particular by, risking to disintermediate banks and hamper monetary transmission going forward. Now, what we want to look at is how retail CBDC could be an opportunity for our monetary policy. So we are sort of turning the perspective here. And so our perspective is that retail CBDC could be used as a complementary monetary policy tool, sort of in addition to the conventional monetary policy tool, but also unconventional monetary policy tool that, as you know, have been used extensively during the low inflation, low interest rate environment that we were experiencing for quite some time before inflation came back. Now, just a very brief primer on the existing monetary policy instruments, which we, can enumerate as open market operations, standing facilities. Both of them are so-called bilateral instruments, so they require the consensus or agreement not only by the central bank, but also by the financial institutions that are the central bank's counterparties. And then there is unilateral instruments that, are just initiated basically on the initiative of the central bank, do not require agreement by the monetary policy counterparties, which are minimum reserve requirements and interest rates on central bank reserves. What we can see from this table is obviously that the central bank to date conducts monetary policy operations with a very select group of counterparties, which are financial institutions, mostly banks. Now, if we look at the existing forms of money and how they play into monetary policy to date, we've spoken about central bank reserves, we've spoken about banknotes and coins, we've spoken about commercial bank deposits, and Christian already said, in the case of banknotes and coins, right, that the influence of the central bank on the quantity of banknotes in circulation is an indirect one. It confines itself to passive management, to fulfilling the public demand, on which it does not take influence. That's very different when we look at central bank reserves that are a monetary policy instrument where the central bank takes direct influence and actively manages the quantity that is in circulation. And then obviously when it comes to commercial bank deposits, its influence is also only an indirect one. Now, the question that we could ask ourselves going forward is, how should central banks take influence on the quantity of retail CBDC in circulation? Should it be, like Christian implied in his comments, should it be a stance like comparable to the one that it takes when it comes to banknotes? Should it be an indirect influence? Should it be passive management? Or could it be a more active management? Now, there is two potential ways in which retail CBDC could be used as a monetary policy instrument. You could think of retail CBDC holdings, a central bank paying or charging interest on retail CBDC holdings, similar to the way the central bank pays and charges interest on central bank reserves. That is one way. Obviously, interest is not interest like it is paid on deposits of commercial banks. It's not meant to be a compensation for credit risks that people take on by holding retail CBDC, right? It is a sort of subsidy, a state subsidy that is paid on these holdings to fulfill monetary policy objectives. So that would be the use case number one. Use case number two that we could imagine is by the central bank managing the quantity of retail CBDC in circulation through outright monetary transfers to the public. Now, in our paper, we are rather critical of the idea of an interest-bearing retail CBDC, and that's in line with the discussions by policymakers around the world. It seems to be that most central banks are considering a retail CBDC that is non-interest-bearing, including the digital euro proposal by the Commission. There's several disadvantages to an interest-bearing retail CBDC. It would blur the line between a monetary and investment object. It would yield a return for the holders of retail CBDC, but it would not really mean a real investment, right? So it could crowd out, in the worst case, real investment. So that's something we would like to avoid. It would compete most likely more directly with commercial bank deposits, right, that are yielding and would increase the risk that Christos discussed, the risk of bank disintermediation, and that is in fact the main reason why it is probably not considered as a policy option by most central banks. And then finally, it would render the conduct of monetary policy more complex because it would constitute an additional policy rate. I see Christian shaking his head, so I guess we will come back to that in the discussion. Now, monetary, we are more in favor of the possibility of outright monetary transfer of retail CBDC to the public. You can imagine that as a form of the good old helicopter money that goes back to Milton Friedman, right? Obviously, helicopter money or outright monetary transfers is not something that you cannot do without retail CBDC. But obviously, a retail CBDC would facilitate that option quite a bit in terms of its implementation. So the central bank could distribute newly created retail CBDC directly to the wallets, directly to the accounts of the general public holding it. That would create an instantaneous, a one-off increase in the total amount of money in circulation. Now, there have been some studies, some estimates out there on the effects that such outright transfers would have in the euro area. And they show that a transfer of, for example, 120 billion euros, which would be roughly 400 euros per individual, or 1% of euro area GDP, that would increase inflation by 0.5%. And these estimates are in fact quite linear. So if you increase that amount, if you double that amount, the effect on inflation also doubles. So it appears to be quite an effective instrument if we believe in those estimates. Now, so if we consider outright monetary transfers of retail CBDC as an additional monetary policy instrument, how would that fit into the framework that we have in place today? I already mentioned the distinction between bilateral and unilateral monetary policy instruments. Obviously, outright monetary transfers would qualify as a unilateral monetary policy instrument. It would be initiated upon the initiation by the central bank. Although in terms of implementation, it might be necessary that you have some form of registration by retail CBDC holders to receive ultimately that amount. Depends on who should be the recipients of these transfers. So whether it's fully unilateral is a question of implementation. And then we distinguish temporary central bank money that is created by the use of different monetary policy instruments, or the open-end, or whether central bank money is created open-ended. Outright monetary transfers would fall into the second category, right? They would not come with a maturity, and what makes them very special is that you do not have a sort of natural reverse transaction, unless you want to withdraw funds from your retail CBDC account holders, which you definitely don't want to do. But that is something that makes this instrument quite special in comparison with existing instruments. Now, why are outright monetary policy transfers of retail CBDC an interesting option? They could offer a more direct and more effective way of stimulating aggregate demand if, especially in environments of very low interest rates, of low inflation, they're also less likely to produce side effects that we have seen with existing monetary policy instruments. In particular, that's an aspect that we discuss at length in the paper. They might be more equitable than the asset purchases, the quantitative easing transactions that we've seen after the sovereign debt crisis, especially in the EU, that have increased income and wealth inequality throughout the area. And then finally, I'm conscious of time. I want to mention a couple of caveats and challenges that we do not really discuss in the paper. Okay. Well, more time for the discussion. We discuss this the potential use of retail CBDC as a monetary policy instrument really sort of at a very high level. We just want to put the idea out there, compare the different options. Now, obviously, we do not make the claim that this use of retail CBDC for direct monetary transfers would be legally feasible in different jurisdictions. There may be restrictions by central banks' mandates, by the legal frameworks that underpin their monetary policy and their money issuance powers. So we do not touch upon that in the paper. And obviously, you can think of a range of implementation challenges that the central bank would have. That's probably for a follow-up paper for us to discuss. Now, clearly, such a use would depend on a rather broad uptake of retail CBDC. If you want to use it as helicopter money that reaches as broad a circle of society in your jurisdiction, then obviously uptake would have to be very broad. You could raise the question of who should be the recipients of these transfers, right? You would have to define the circle. Is it citizens of the euro area? Is it residents of the euro area? Is it citizen residents of the euro area? How do you know whether people, account holders, or how does the central bank know whether account holders or wallet holders are citizens, residents within the euro area? And then depending on the way retail CBDC is distributed, the privacy requirements attached to it, you may, need as a central bank the help of intermediating payment service providers. There's the question of how that plays together with holding limit. So within the euro area, we are discussing the waterfall mechanism. So these transfers, if they'd go above holding limits, they would just be rerouted to the banking system. It's not something that the central bank wants. Is it a problem? Or is it okay? Because any form of money that enters into circulation will cause the same desired effect. And you'll obviously have the risk of, or the challenge of calibration. How much, should you transfer? It's a very new instrument that would have to be tested. And there is a risk of overissuance that would be more difficult to, it would be more difficult to withdraw liquidity that you overissue as a central bank, because there is no natural reverse transaction to these transfers. So with that, I would conclude, and I thank you for your attention.
Now it's time to go online. We have the first speaker remotely connected. Yes, confirming. Oh, good morning, Professor Marko Dimitrijević from Palermo. The University of Palermo in this case, because it's just for a visiting period there. I leave the floor immediately to you. You have 7 minutes as the other speakers. Thank you so much for joining us.
Professor Zatti and dear respected conference participants, thank you so much for this kind introduction. It is my great honor and pleasure to be able to participate at this tremendous conference. And first of all, I would like to excuse myself for not being able to participate in person because of some previously arranged obligation. But I'm quite thankful for this online possibility to listen and to learn about some dilemmas in CBDC legislation today from the respected authors, which paper I gladly read. Now I shall try to share my presentation. I truly hope that you can see it. I guess that when we speak about some remarks on digital legal tender implication on public monetary management, it seems that contemporary monetary law actually find its new sources in sometimes a little bit controversial facts, which are not purely legal or economic in its nature. And I guess that technological development is actually quite good example of those new sources, where for the first time ever, we actually have some radical changes in the path of monetary sovereignty implementation. I guess that every time, monetary system find itself, faced with some new challenges, it must be de facto or de jure modified in order, to retain its accountability, its credibility, and of course, its transparency. I know that there is one very beautiful analogy which actually can speak about what happens in the era of monetary legislation nowadays. And we actually speak about, that symbolical transition from that Copernicus era where everything was over around the sun. And, that sun was just a euphemism for the gold and golden standard, to new Einstein era of universal relativity, where actually in the center of that universal relativity we used to have electronic money. But the introduction of electronic money in the monetary legislation has some features of so-called quiet revolution. I'm not quite sure the emergence of the digital currency, private one or the sovereign one, has that characteristics. And of course, the mention of Nicola Copernicus is not just some random choice of the word, because in 1526, in his famous work Monete Ratio, he actually perceived some kind of cashless society where we do not use, coins in that form as we used to. Also, there are some similarity, in happening right now with something which already had been happened once, just in Florence, if I'm right, in 13th century, in the moment before the emergence of the first banknote, which was also a very controversial question, once. I guess that today monetary law confirm its role as a precious answer of legal science to those changes which actually follow, the implementation of the law of the value as economic regularity in the circumstances when the scope of that legal rules is sustainable and reachable, of course. When we speak about the notion of legal tender for central bank digital currency, I guess that future legal tender should also fulfill that condition for classical legal tender. As Professor Gortsos emphasized, there is, that condition to be legally enforceable, which also includes some standardized unit issued by the central bank or backed up by fiat or commodity. So beside that mandatory acceptance, discharging rule, there is also, that full face value. But it seems, at least to me, that for the first time ever in the monetary history, we also have that new element, which includes encoding the legal norm in the process of that legal tender. And, it is not purely normative question to be resolved. And because of that, there is real and logical need for maybe forming some multidisciplinary team, which include not only jurists and economists, but also some other, professional from the field of technical science, in order to provide some sustainable and solid solution in this area. I guess that the primary role of the legal tender is not to be the tool of the monetary policy, of course. The main ratio is actually for the state to keep its position as holder and custodian of monetary sovereignty, to maybe towards technocracy, and also to reestablish its role as the main, monetary legal innovator with some very artistic and ingenious mnemotechnique in this area. So the main features with the legal tender actually, is that bounding to the single currency, which states, find appropriate in this, and maybe that is not in compliance with that free will and, free choice of buyers and merchants today. I guess that the emergence of private digital currencies also can be some kind of solid proof that, some grain of that primordial monetary sovereignty, in our consciousness. And maybe that is actually a solid proof that monetary sovereignty per se is not some ideological, faraway and vague integral component of political sovereignty. It is actually quite vivid. And in that public-private partnership, if I may say that, between the central bank as supreme monetary institution from one side and the interesting party from the private sector, maybe we can find, some solution which will enable that, profound interoperability between the legal system from one side and, of course, that technological development from the other side. If that legal tender understood and has the role to be some barrage against non-acceptance of other alternative currency, that of course is in collision with the open and the free development of monetary and financial innovation today. And I guess that, even Roman jurists once noticed that utility of the money on the monetary units depends not just on nominal quantity of its units, it also depends on public belief about that. Some principle of that social theory of money are actually still present this day, because in monetary history, we used to have that example when people do not want to use official monetary units because they actually have so much faith in some alternative currency. And that is something which speaks a lot about, insufficient credibility of that domestic monetary institution. I also think that, it is very necessary to establish that public monetary management to be, more that human take friendly, in the meaning that the central bank is not just the bank of all bank, but bank of people who listen and respect their will. And today people actually want to have that access to the Internet of Things as that global network of interconnected devices to fulfill their preferences in the market, which is more digitized and digitalized every day. And that is important for them, in order to save not just financial cost, but also time cost and that psychological cost in the process of fulfilling that preferences. I guess that, concrete type and design of central bank digital currency legal tender can also affect some monetary and fiscal policy implication in this, because if, for example, we speak about repressive model, then we have that fear of imposing some financial sanctions and penalties. If, for example, that contracting party do not want to accept monetary object, which has that characteristics of the legal tender. From the other side, we also have that example of the exclusive model, where there is no fees of imposing, penalties, but it is desirable to accept that monetary object. There is some, peer pressure model in that context, not, of course, the threat by imposing penalties in concrete monetary jurisdiction. We also have some example of using so-called indicative model of legal tender of CBDC, where, for example, state can provide some grant for accepting that concrete design of CBDC, and of course the privileged one, where there is, some other grant which state can use in order, to create that habit among monetary habitants to use that concrete type of central bank digital currency. I guess that, of course, when we speak about that legal tender influence on financial stability, that is something which actually appears as conditio sine qua non for overall economic stability. And as Professor Gortsos and other participants emphasize that, I guess that of course, that level of influence can be affected with the level of acceptance of CBDC today. I completely agree with Dr. Christian that, in practice, people do not make that changes in the meaning of the legal tender, especially legal tender, cash, private, and sovereign digital currency, because, monetary legislation, especially central bank legislation, is not like CERTA, and there is real and logical need for, providing some additional explanation. I guess that, of course, in this, we can notice that differences between, for example, wholesale type and retail type of CBDC can be important in practice, especially when we speak about the influence of retail type of CBDC in some smaller monetary jurisdiction, in some smaller economies, where, for example, we have that, discrepancy in the meaning of the development level between concrete, region under that monetary jurisdiction. For example, we still have that phenomena of unbanked or underbanked, monetary inhabitants and people who actually do not have an open bank account in their cities, village or municipalities, or they do not actually want to use that services of concrete commercial bank which operates down there. And sometimes state is not, interesting to provide that infrastructure because it is very, expensive. And during that high cost of investment, certain commercial bank can be also reluctant, to that. I guess that in case of retail type, which will be enabled to all interesting parties, not just to that real-time growth settlement, as commercial bank and other financial intermediary, maybe that can, provide some profound financial inclusion, especially in those smaller economies. I think that that can be better solution if we combine that retail type, with that offline platform as potential solution. Also, one very important aspect of using CBDC refer to its function of collateral. For example, in our domestic monetary jurisdiction, a lion can use, this for securing his claim. For example, for monetary claim which is expressed in domestic or in foreign currency, or non-monetary claim which are expressed in the form of digital asset, that digital asset, broadly speaking, has the use of collateral. But I think that, everything depends, especially from economic point of view. The other participant will know that so much better than me. Does CBDC and bank reserve can be treated as substitute, if they have the same resource scores per unit? That will be something which also affects that, discount window lending rate and restrictiveness of collateral framework. So the influence on the real economy, business model, and investment decision, can be different in those situations. One potentially, good effect can be on shortening that time lag, especially in the process of creation the concept of general economic policy, because that problem of internal and external time lag is quite difficult to resolve these days because of that pass of the time where problem occur in a certain subsystem of general economic policy and the time which actually require the use of concrete action. Maybe if that pass in the change of the interest rate became noticeable to everyone, I guess that, that can influence that intermediate delay will be shortened in that time. But, again, today when we speak about implementation of monetary sovereignty in terms of technological evolution, we actually have that phenomena of so-called monetary sovereignty trilemma, because for the first time ever, we have that collision of interest in three lines. The first one is, of course, people against state, against central bank. We also have that collision in the line between the big tech companies, which, for example, create that platform for using digital currency, and people, and of course that collision interest between, the big tech companies and the central bank as a supreme monetary institution. I guess that very useful concept, in this can be actually the concept of so-called reflexive law approach, because it is something which emphasizes the importance of legal rules. In this case, that will be monetary legal norm for, correcting and redefining that self-regulated democratic mechanism, which we actually have in the essence, in the nature of using redistributive ledger technology or maybe centralized ledger technology. Everything depends on certain design of CBDC. But I guess that, by using that, we can make that transition from fintech to become legal tech, and finally, people tech in service to create some welfare and better condition for living of all people and monetary habitants. When I speak about monetary habitants, I actually think about people who live inside the border of that monetary jurisdiction, where we can see that full implementation of primary and secondary monetary legislation. And I must say that I believe that beside monetary law as positive legal branch and central bank law, we also have that special category of economic right, let's call them monetary right. And that is super important, especially, in smaller economy, to provide that right, to have solid, firm, convertible, currency and monetary stability as some kind of global public good, of course. So I guess that, maybe the emergence of this fintech and general technology in the science of monetary law is not only disruptive, I guess that can be also foundational, if we change the focus a little bit, and that sui generis public partnership between the central bank and the private sector and other entities which are actually willing to solve and which are willing to participate in this, we can find some solution which will be with that component of formal but also social legitimacy, which is nowadays very, very important. And I guess that combination and that synergetic approach between bottom to up approach, which we actually has in the case of the emerging of private digital money, and that up to bottom, which we have in the case of all this extensive research about issuing CBDC, can provide maybe some sustainable answer and good solution in this area. So, Professor, thank you so much, and thank you so much for your attention and your time.
Thank you, Professor Dimitrijević. Thank you so much for your food for thought. We are moving immediately. We risk to be short of time with the only one is connected, but we have two friends here in person. So we have a sort of liaison. Professor Douglas Arner, are you with us?
Yes. Many thanks, Filippo, and thank you very much for the invitation to join. I'm really sorry not to be there in person, but greetings to everyone from Melbourne. What I want to do is kind of build on some of the other themes, in particular, Marko's paper just now. And I'm going to bring up a few slides. And essentially, the focus here is from the standpoint of the cross-border context. In other words, moving from, if you will, the European regional context to what we're seeing in a range of other cross-border contexts. And the context here is really coming out of a project which has been led by University of Virginia, looking at the role of geopolitics in the context of finance. And my particular focus has been the interrelationship between finance, technology, and geopolitics. And what I want to frame today is building on that work with Pierre Verdier to move on to another level, which is really from the standpoint of thinking about how these factors are coming together in the context of new efforts to use domestic currencies to a greater extent internationally. And this builds first on some joint work with Ross Buckley, who's there in person, as well as Dirk Zetsche, our recent book on finance technology and regulation. And one of the key themes to come out of that is this idea that finance, technology, economies, and legal arrangements are co-developmental. And I think this is something that Marko's presentation just before was very much highlighting the interrelationships here. And one way that I frame this is that as technological horizons change, that enables new systems, which in turn interact with geopolitical arrangements as well as legal and regulatory systems. And I think if we look at the world today, there are a number of areas where we see this happening. One of the most important is in the context of cross-border monetary and payment systems. And this is a process that Ross and Dirk and I, along with Anton Didinko, investigated in an earlier piece. And in that piece, we essentially look at the idea of cross-border monetary and payment systems. And traditionally, if one looks at international monetary instruments, there's a focus on a traditional functional economic analysis, the role of the monetary unit as a medium of exchange, as a unit of account, as a store of value. And very frequently, the analyses relate to geopolitical evolution. In other words, there's often a linkage between whatever the major economy or major economies of a given period may be. But going back to Filippo's very first point, just as important in our framing is the mechanisms that are available for mobilizing that monetary instrument. And this is really the intersection of monetary instruments with payment systems. And it's at this point, this linkage, where we add to that traditional and developmental roles of technology and of law. And I'm not going to review the broader picture today, but where I want to flag is essentially the idea that over the past, I would say really about 50 years, from the early 1970s up to the present, we have seen a dramatic change in the technological horizons of money and of payments. And this has been both from the standpoint of centralized systems. One can think about the evolution of RTGS systems, of mobile money systems, of fast payment systems, and one can also think about more recently, over the past 15 years or so, since the Bitcoin white paper in 2008 and the advent of the first blockchain system in 2009, in the context of decentralized systems. But something that has been flagged is we are increasingly seeing these come together. So for instance, if we look at central bank digital currencies, almost without exception, the design of CBDC systems, although heavily influenced by stablecoin experiences or by blockchain-based structures, are actually centralized structures. They are often taking the technologies from high-value, high-speed centralized systems and applying that to a tokenized form of money. Related, we see fast payment systems, which are not tokenized, but are similar sorts of centralized systems. Coming with this change in technological horizons of money and payment have been, if you will, an ongoing process from a legal and regulatory standpoint of struggling to bring our systems, which are often designed for earlier these technological horizons, in line with the changing technological horizons. And coming into that, we are seeing particularly the impact of geopolitical factors ranging, I would say, particularly from the Russia-Ukraine war, but also from a range of actions coming from the current administration in the United States. And if I want to look internationally at what we're seeing in the context of cross-border monetary and payment systems, there's a general trend whereby countries more or less everywhere are looking at mechanisms not only to make cross-border payments and transactions easier, but at the same time to also, and this relates to the monetary sovereignty point, to also increase the use of their own domestic monetary systems in the context of cross-border transactions. And if I want to frame this from the standpoint of retail, I would say that there are four areas where we're seeing the most significant co-development of technology, regulation, geopolitics, and money and payments. The first is in the context of linking fast payment systems. And probably the highest profile example of this have been efforts coordinated by the Bank for International Settlements in the context of the more developed members of ASEAN, the Association of Southeast Asian Nations, in the context of what is called Project Nexus. Project Nexus seeks to link domestic fast payments on a cross-border basis. Now, the technology has been very straightforward for the simple reason that all of the countries involved have adopted their fast payment systems within the past decade, and so the technologies are quite similar. The linkages are simple. The complexities, as is so often the case, have been around the legal and governance arrangements. In particular, how do you set up the legal entity, the jurisdiction, the governing law, the dispute systems? One thing that ASEAN has benefited from is the past over 25 years of work in the context of the aftermath of the 1997 Asian financial crisis of bringing banking regulation and AML systems more closely together. And I think one of the reasons why Nexus has been workable is that trust and harmonization effort from the standpoint of banking regulation and AML. But they're facing two big issues. The first is how to deal with fraud and crime. The fact that when one makes it easier to do cross-border digital transactions, one immediately enables criminals and fraudsters. And how to deal with this is proving a major challenge. The second is that this system, which is really the second point I'm going to make, doesn't address Forex problems. And the Forex problems still remain an issue that has to be developed. The second area where I think we're seeing very rapid developments is in the context of regulated stablecoins. There's a real question globally whether particularly the advent of regulated US dollar stablecoins may in fact make it easier to use the US dollar internationally, and this sort of, if you will, push and pull between the geopolitical factors and some of the convenience factors that Christian mentioned at the very beginning. But moving to regulated stablecoins, I think there is a view that this is potentially a game changer from the standpoint, particularly of enabling the use of major currencies more easily on a cross-border basis. From the standpoint of cryptocurrencies, I think this is quite an interesting piece, because if we look around the world, in a large number of jurisdictions, we find that for the under 35 demographic, a higher percentage of under 35s in a large number of jurisdictions have used cryptocurrencies to a greater extent than traditional financial instruments. What this highlights is that the infrastructure has been built, and that it may well be the situation that as new instruments such as regulated stablecoins or central bank digital currencies come into use, that infrastructure enables their wide cross-border use. From the standpoint of retail central bank digital currencies, in most of the world, and I would say the EU is perhaps an exception here, we're seeing a slowdown in projects. There's a view in many cases that the take-up has perhaps been less spectacular than was expected in some cases, and that in particular, alternatives like fast payment systems in many jurisdictions are actually providing a better alternative. With that said, we are seeing a continuation of most of the projects, but with a general view that one is less likely to have retail dominance by these new central bank digital currencies, particularly in the face of competitors like fast payment systems. On the other hand, where we are seeing, I think, some very significant digital currency side is on the wholesale side. And I mentioned this problem in the context of Nexus, that they don't address the foreign exchange problem. And one of our challenges is that for most currencies in the world, the liquidity is higher between currency and dollar than currency pairs. So that in a very large percentage of transactions, the dollar ends up as an intermediary currency. And so we have a number of projects such as Project Imbridge or Project Aperta, which are looking at how these frameworks, how new technologies may be able to ease those liquidity problems. Now, if we're looking forward, as I said, I think a takeaway, something to think about, is that as we see a variety of jurisdictions thinking about increasing the international use of their own currencies, what we see is that the US dollar does have certain advantages from the standpoint of the infrastructure, particularly payment systems, but also, and this is probably the biggest challenge, in the context of the store of value function, and particularly the availability of highly liquid, safe asset markets. And if one wants to look at other major currencies, this is often the area where they suffer by comparison. And if one wanted to look forward from the standpoint of co-development to support greater internationalization of the use of a major currency, I think the area where the greatest focus is going to be needed is twofold. One, the payment systems arrangements, and two, debt market liquidity, and in particular, thinking about how one can deliver the sufficient size and scale of a safe asset market that would be necessary to support a major currency alternative. So I've tried in this presentation to really bring in the cross-border context and what we're seeing, as well as this idea of co-development of finance technology arrangements. Thank you.
Thank you so much, Professor Arner. It was a pity not to have you in person. I hope there is another opportunity to invite you here in Florence. And next, immediately, because we have 15 minutes to the first break, even if probably we raise something, we going through a rapid short question, if the speakers allow me to do that. I see Professor Wang. Very welcome also to you. Thank you for joining us, having accepted our invitation. Welcome.
Thank you so much, Professor Filippo, Zatti, and hello everyone. It's been fantastic to be here. So let me share my slides. So what I would like to talk about today is about how to resolve digitalization disputes. I think it's also very much connected with the discussion we have seen just now by Professor Dr. Sala and other panelists. that affects a lot of issue about, how do we make the digitalization system work, CBDC, and also how, that may contribute or affect, not only the operation of this, may broadly, international relations, geoeconomics, and also the trust and confidence in that. So what I try to discuss now is about, how do we, dealing with the disputes that may arise from the financial, CBDC, because in whatever payment system or financial system, disputes are hardly, it's hard to completely avoid it. So I would talk about, at the very beginning, the trend, of global financial network, the broad picture of the context, and look into then the actors' relationships, and further to the disputes, or whether we see a uniqueness of the, wholesale, particular CBDC dispute settlements, and to conclude with some final elements that may be relevant if we think about the CBDC dispute settlement arrangement. So at the very beginning, if you see here that I have a previous paper with Professor Gao Simi of the Tsinghua University, we look into the, what is CBDC means for, international financial system. And what we found that actually we are seeing a kind of, landscape change from the, originally be more centralized US dollar as a center to more decentralized system. So which means that you have a clusters. If we think every country as a dot points, as a node, we see a different groups of country, like-minded ones. They are exploring CBDC. If you think about G7, you can think about other countries, and then we'd like to see a more decentralized system. And it's hard to find a centralized CBDC in this network that impacts the global financial system. But also, they also may mean that you may also have disputes or disagreements, among different groups of CBDCs, or, if you think about cross-border CBDC as one example. And then, if we look into the structure or architecture of the, cross-border CBDC I mentioned earlier, and we have a different modes of that, so, you have a possibility to have a compatibility systems, are trying to align with, regulatory framework according to a BS report in 2023, or you can try to interlink, national CBDC systems, and that requires, how do you, have a transaction across different currency areas and also national ID schemes, or certainly you have a kind of single cross-border CBDC system. That's what we see in many, exploration that different patterns has been used. And then that also means that it's they have a different, depending on the modes, they have different kinds of complexity. So for example, if you have a common platform, and how do you deal with divergent national approach to, to CBDC or to data governance will be an issue. So we see that there are different modes, add complexity to the CBDC operation and means more difficulties we may face in solve disputes. And then we may be looking to the actors. So what are the actors that are involved? So of course we see that they start with central banks, who are issuing CBDCs, but of course, as mentioned by Dr. Sala and other colleagues, international organization like BIS, World Bank and other. And then you also have another player, which has been a very important one, or infrastructure, is the wholesale CBDC platform. And that is very important one because, or other modes, because you actually will rely on infrastructure, to have a cross-border use of CBDC, and also a lot of design or rules are based on that infrastructure. So that is a critical important because in the past, if you compare trade, for example, you don't really have such heavy reliance on single or central infrastructure. And of course, you have intermediaries, like commercial banks. You also have reliance on vendors, other actors like technology companies, and of course, you also have the users, foreign holders and others. So the disputes or disagreements are likely to involve at least, from central banks, commercial banks, technology suppliers, depends, and also users and many others. So there are, there could be old players like commercial banks. There also could be new players, like say tech companies. Now we maybe look into the relationships, that may arise in the CBDC. They are very important because, they may shape the kind of disputes we may face. And for example, if we look into, projects, Enbridge as one example, which involves mainland China, Hong Kong, UAE, and others, you see that actually they have different kind of relationship. If we look into the cross-border CBDC platform, administrator, and participating central banks, they may have a contractual relationship, which based on the platform terms. And also you have relationship, second category, between central banks and intermediaries. That also be a contractual one, but here you have, public-private actor involved. And they are reflected in the pilot participation agreements, platform terms, and other. And third category is that you have the central banks and the holders, CBDC holders. There can be a contractual one, depending on how do you design the CBDCs. And then have others like, intermediaries and users. They also could have a contractual relationship, but it's based on external terms. So we see that, we are like to see a quite complex kind of disputes. One way you look into that, you may have state-to-state disputes. If, for example, two countries use a platform and send conflicting signals, or direction to payment, and then they may have disputes. Or if there's been, data breaches, or spillover effects of the risk from one country to another. So these are one kind of possibilities. And second kind of disputes between those between public and private entities. You can think about liability of central banks if you have any defective CBDCs or if there's any security issues, because currently there are observations that we can hardly guarantee 100% safe. And so these are some, for cybersecurity perspective, there always been risks, you may be cyber attacked. So here's being a liability issue, but also even potential investor-state disputes. The third category of disputes are happening between private parties, payer, payees, and commercial banks and payer, payees, and so on and so forth. So that means we are like to see a kind of quite wide range of disputes. And if we categorize those kind of disputes, they may be arising from, looking to their causes, arising from technological issues, failures, data integrity issue, cybersecurity ones, or they can be regulatory legal issues like data privacy, different regulation or conflict, or violation of the platform documents, due diligence standards, differences, consumer protection ones, even insolvency of the actors. And they may have some of them cover both, cover both technology and regulatory issues like interoperability or fraud. So we see that, there are a wide range of the dispute that may need to be considered carefully before, the CBDCs are issued or being used across the borders. And we have looked into the, disputes, different relationships, actors. Then we probably want, one question is that, are the wholesale or cross-border CBDC dispute settlement different from the previous ones we have, in other areas like trade or and beyond? We can use kind of the, typical transnational economic governance models used by other scholars as a basis. They have at least three kinds of structures. One, you may look into private contracting. So the dispute settlements will rely on contracts. You have private parties or other parties agree on the contract. Or second category is interstate contracting. So that means, you can use treaties, you can use other form MOUs, for example, investment treaty or free trade agreements. But here, for example, for private contracting, it may not be so common in the sense of CBDC, particularly if you look into the relationship involving central banks. So it may be difficult for central banks to have a private contracting, with other users. And secondly, even for the interstate contracting, it's not common to have the treaties or anything close to that for the CBDC. For MOUs, they may take time to deal with that, but for current projects, they are not so common relating to CBDC. A third category of traditional governance model is a principled multilateralism. So that means you could have a kind of, in trade, for example, you have a World Trade Organization, or if IMF and in finance sector, and that requires to coordinate different clusters of CBD, different groups of CBDCs, and that means that you have to solve many issues like data sovereignty, and also how to deal with if you have multilateral disputes, whether you are able to have international adjudicators. There looks to be quite a lot of difficulties to feed, to work with CBDC dispute settlement along these three lines. So you could have some reasons for them to use, for example, private contracting, maybe used for private entities, involving CBDC, and you can use commercial banks in the continuous contract to do that, but you cannot cover everything, because for central bank parts that's a little bit challenging. For interstate contracting, they have the issue about how do you deal with the lack of treaties or even MOUs to dealing with that, and also if you use that, even if you agree on MOUs, how do you deal with new members? How to deal with a different rule of different clusters? If you think about whether you have CBDC, for multilateralism, that requires you to build consensus. And one of the typical issues we have is, as mentioned earlier, by the panelists, the trust is being an issue, because CBDC behind it is also about social value, and also including issues like recognition, acceptance of foreign CBDCs. So it looks like that all three of them may be used in some perspective, but it's hard to fit into any one category of that. Even for some like multilateralism, it's really difficult. And for this part, I would like to conclude by saying that we'd like to see that, for whatever governance models, one unique perspective of CBDC is that the heavy reliance on infrastructure. If you think about CBDC platforms or hubs, the dispute settlement system will be affected or will need to be built into the infrastructure. That's something will be critical. So that is, may have a geoeconomic implications, depends on who develops the infrastructure and whether the infrastructure can be linked with the domestic system, or the CBDC platform A can be working with CBDC platform B. So there are many critical issues. To conclude, I would like to see that if we bear in mind those complexities of legal relationships, or actors, and also the difficulty for traditional model of governance, from private contracting to multilateralism to the CBDC dispute settlement scenario, we probably have to think about the major elements that we may think of in that regard. And here we have a paper which will be published in Memorial International Law Review recently about CBDC disputes. And for those kind of disputes, there are some elements that we can learn from Smith and Martinez's work on dispute settlement to look into what we can think about the CBDC. So one thing is about the goals. So what are the disputes that will be addressed by a CBDC dispute settlement arrangement? So it's unlikely to have central banks go to courts to deal with this issue. So if you have a cross-border CBDCs, if you cannot solve by negotiation, how do you solve that? And also, how do we set, for example, efficient and fair handling or prevention of disputes as a major goal? So there are so many different kinds of disputes. What are the issues that dispute will address? How do we ensure its efficiency and fairness will be critical. And the second aspect that deserves attention in the design of CBDCs regarding dispute settlement is also think about formal and informal dispute settlement. You could have the formal one where a third party involved, or bilateral ones, which you don't involve third parties, or internal process where you have CBDC platform dealing with those disputes, or you go to external processes. And also you have a question about who is responsible for settle disputes. Are you talking about intermediaries or the commercial banks, which can designate, for example, officers to deal with that? If they cannot solve disputes, maybe they can escalate to central banks. So these are various issues that you have to think about. And also, how do we adapt, existing dispute settlement processes, to the CBD dispute? And thirdly, stakeholders, how do we engage with that? Because there's so many new and old, existing stakeholders. And how do we strike the trade-offs, maybe starting from a small scale, like-minded actors, and then build upon, that for extend to a broader CBDC network. And also resources, So that's also be an issue. If a disputes, how do you have a sustainable technology, human, financial resources for that? That's particularly important for developing countries, because CBDCs was issued. It means that you have to be always at the forefront of that as the central banks, because cybersecurity and other issues keep on, evolving. And finally, that is a success. How do we review, have oversight of that? How do we monitor the dispute settlement mechanism operation, including their defects? And how do we ensure an efficient mechanism in the long term? And with foresight, because, we like to face dynamics from technology evolvement to international relation dynamics. Yeah. So I think I would like to stop here, and thank you so much.
Thank you, Professor Wang. We are late, 3 minutes late, and I first want to thank all the speakers for respecting the time. To me, is very important. And the second point is, seemed that we organized it, because I was very strict acted, from the economic side to the private. So I have to stop here because we have a refreshment now, and I don't want to erode times to the next panel. I see the chair, Professor Vespri, but I leave you a question. Probably I'll send you by an email. If you were a legislator, how would you address digital legal tender?